I'm Brendan Yurik, the CEO of Electric Royalties, a royalty company focused exclusively on those clean energy metals really required to move the world forward towards a green energy future. We've got 21 royalties in our portfolio right now, one of those which we're currently closing on. We've got Cashflow. We've got a number of royalties that we expect to come into production next year. And over $400 million has been raised in the last 18 months. That's all going into the ground, developing our assets at no cost to us, thanks to the royalty business model. And it's exciting times ahead. We're about 40% lithium right now, and lithium prices are obviously doing pretty well.
They're doing well. How are you?
I'm doing good. It's good to see you in person.
It's really
finally.
Weird. It's the first time we've actually met in person. Right?
I know, it's crazy.
Right? It's
it's crazy.
Well, welcome to London. Sorry about the weather. It's not our fault.
It's just like that in Vancouver.
Is it? Oh, that's good. That's good here. Hey, look, we're starting to sort of introduce you to a kind of bigger audience who are perhaps looking into royalties and trying to wonder what it stands for. Most royalty companies, as we know, precious metal focus, right?
Yeah.
You're not. Relatively unique in that sense. Are people getting the difference between a precious metal royalty opportunity versus the battery?
I don't think they are. First, look, the pricing upside on the battery metal side is much more significant than precious metals.
Right.
Biggest average price increase in gold on an annual basis, I think it's 20% last 10 years. Lithium prices have gone from $400 a ton for lithium spodumene up to as high as $7,500 a ton. Yeah. And that's over the last kind of 2 years. We bought most of our royalties when lithium was $400 a ton. Yeah. Our revenues expected are directly proportional to that. So that's a significant upside that you would never see, I don't think, in gold, unless gold goes to 50,000, right, an ounce. So that's one of the things. I think the other part is there's very few of these deposits. You actually need these metals. These are critical metals. They don't occur everywhere. There's a lot of gold deposits. If you look at North America anywhere, right? Gold deposit there, everywhere. You look at our portfolio, we've got, Battery Hill, the only manganese district, all of North America, right? There's really one deposit. We have Sleetat. It's the best tin asset in the U.S. Several years from production, but there's almost nothing, behind that. 5-8 years probably you have to look behind that. So these projects are very unique. I think there's more impetus for them to get built. There's an actual need for these projects, especially when you look at domestically. Yeah,
but here's the thing about you, right? Because you've been this last year since we've been talking. Market caps are down here. You placed all your bets a while back. Talk about contrarian investing, which we were a few weeks ago. Before people kind of saw the need for this coming through. In fact, one of the questions I used to ask you was, "Why aren't you in gold? You should be chasing gold." It's like, no, we're not going to, because of moments like this. When's the market going to turn for you, though? When do you think that's going to happen?
Next year. I think next year.
Because of what?
I think we're cash flow positive next year.
Right.
We have a royalty on the Oche lithium project. It's operated by Sayona Mining. They've raised $200 million in the last 6 months. Yeah. And they're targeting production for Q1 2023. That'll be the only producing lithium mine in Canada.
Right. What were they valued at when you first invested in it?
When we bought that royalty, Sayona was about a $6 million company.
What are they now?
They're close to $2 billion.
Any thoughts? Any special thoughts?
Well, I watched their market cap go up $700 million on news on our royalty. So that's 30 times our whole valuation. Yeah. And our royalties are right to the cash flows from that project. And so, it does seem disproportional. That's one of 21 royalties that we have as well. Yeah. Our latest deal was on a tin mine. It's the only producing tin mine in all of Europe. Only producing tin tantalum mine in all of Europe. We got a royalty on it. It's only costing us, $1 million. Yeah. Payback, should be around 5 years or so, with a lot of upside from there. That's at current tin prices. There's a lot of opportunity out there where we're already getting the best assets in North America, Europe, and Australia that are going to feed all the need that we have for these clean energy metals.
Why haven't other people kind of rushed into this whole royalty on the battery side of things? They really haven't. There's not that much going on there, right?
No.
And is that because the battery metal companies are not finding it hard to raise capital, therefore they don't need your type of money? Is that the issue?
There's some metals, I would say, are having more trouble than others. Obviously, lithium. Nobody's having trouble raising money right now. There's lithium everywhere. Yeah. A lot of early stage stuff, a lot of stuff that is probably never going to make it, if we're being honest. It's kind of crazy. I mean, the prices that those guys are paying are way more expensive as well, right? They're all competing on precious metals. They're paying, almost equal NAV, right? Net present value, I will pay that. You're going to get that. We're paying, much, much less than that, where our payback is almost on an annual basis.
Yeah, I was about to say, the thing with royalty companies is you kind of got to time the market, right?
Yeah.
There are moments where it really, really works for you, and there are others where you're competing for the type of, like a dollar's a dollar, right? You can call it what you want, but
True.
Companies are saying, I need some money.
Yeah.
I need it to be either non-dilutory or at least majority not non-dilutory.
Everyone loves non-dilutive financing.
Right.
And you can put a royalty on anything. So
Sure.
it is great. It is weird that there aren't more groups doing it. And there's a real need for it, I think, to move this
that doesn't help
forward.
you. That's my point here. It doesn't help. If there's more of it, people can understand it a little
doesn't
bit more,
help,
right?
Yeah,
There's no peer analysis to be done because it's not quite.
We don't have any peers, really.
Exactly,
Exactly,
not quite peers, right?
Yeah.
So, and then I think that's maybe makes it harder for you, right? So, I'm wondering, what do you do about that? Obviously, you're around here. You're meeting people in London, and people are kind of. But you were telling me, they're getting what you're doing.
There's a lot of big money that's starting to move into the space.
Yeah, but okay, they're perhaps looking at you slightly differently from an equity play. Right? Because it's
we're
like
a longer term play. We're much safer, I would say. We're much more secure, right? We don't have to put any more money up for any of these projects, right? So we put up our initial capital cost. That's it. We have no holding costs. We don't put the development costs. We're not on the hook for capital costs.
Right.
When they build the mine, when they're actually in production, our operating costs are zero. So it's very low risk, and most of our royalties run with the property.
I get all that, but what I want to understand is how do you make yourself defensible? Because right now, quite frankly, to be honest, I think you're a takeout target because you're so cheap, you're crazy cheap compared to what's coming down the line, okay? And you've got to say to your shareholders, don't get tempted by the short-term quick money, because quite frankly, if we never did another deal, the upside is X. Or
I don't know if I can actually say that.
I know you can't say that,
but yes, if we were to do absolutely
to.
Nothing, I believe we're cash flow positive next year. And you look at where we're 5 years out, our cash flows could be equal to our current market cap. And most of our assets are very long life assets, from 20 to 47 years in some cases. So these are going to be paying us for a long, long time to come.
Right.
It's kind of a tough position we're in right now.
It's a really tough position, but it's something. It's obvious when we're looking in that potentially that's how you're being viewed, right?
Yeah.
But I can also see that potentially you can flip out one or two of these royalties if you do need the cash, because it's just an annuity stream at some point for you, right?
I think, well, that's the thing. Family offices really understand royalties. They're a really safe way to deploy your capital and preserve that value. In the end of the day, it's tied to the metal in the ground. So when that comes up, you're getting paid. If it's not, it's going to be at some point, and it'll probably be at higher prices.
Right.
But they're very long-term recurring cash flows, and you don't have to do anything to manage that. There's no operating costs or monitoring costs to that. So they're very safe. They're long-term cash flows. And I think when you look at this space, we see a 2 decades opportunity. And that's kind of the exciting thing. Like the real crazy thing is average development timeline, 15 years, right? In mining. First thing we did is go through all these different metals, which not many people, really pay any attention to. Even zinc, which is a huge market, 12 million tons a year.
Well, it had been fairly erratic, and there had been a few blow-ups in the market. So it doesn't really help, and China didn't help. So lots of reasons why people weren't. But it makes me intrigued as to why you did.
Well, when you look at that 15-year development timeline, you look at the projects out there that could fill that gap. If you can see projects that are 10 years ahead of the other projects, just from a development point of view, and there's only 5 or 6 of them, those are going to be the projects that meet that supply, because the other ones won't have a chance to catch up. And so that's what we've really done is we've gone out and picked those kind of most advanced assets, those best assets that will be really needed, and will be the only ones that can fill that gap. You can't make up the time from underinvestment over the last kind of 10, 15 years we've had.
But here's the thing I've always wanted to sort of discuss with royalty companies is like there was a moment when it was a new idea, a new concept, right? And I've said to you, because I've sat the other side of the fence, which is like, I'm CEO of a company, I just need some money. I need you call it what you want. I want to understand the cost of that to me, and I want to understand the some of the terms associated with it. But you and I are going to negotiate what those terms are together. We're big boys, right? Do you think royalty companies, because of what I said earlier, that you got to time the market right? There's a time when royalties make sense, when people are desperate for alternative financing, juniors, to kind of get their projects moving further along. Right now, it feels like there's a lot of cash around. It just feels like there's a lot of cash around. So do you think royalty companies need to reinvent themselves a little bit? Because money's money, right?
Oh, to a degree. I think our business model is great, honestly, and I think we're lucky to be in our space, not competing with anybody right now.
That's great. But who's asking you for money right now?
Who's asking us for money? Oh, we have.
You got deal flow?
We got like 50 deals if we wanted to.
Okay.
Yeah, if we had the money to do it and our valuation made sense.
Right, so, okay, well, let's talk business. So if you wanted to do them desperately, you say you'd go and find the money to do them, right? So when you've got 50 deals on the table, let's say maybe 5% of those are something that you may want to look at doing. How do you go and get the money to do those deals? Because they make sense to you in this market.
Yeah, so that's the challenge. It's really about doing that accretively. Our valuation where we're at today is about 25 million. Mm-hmm. I think there's a number of royalties in our portfolio that on their own, kind of make that look a little bit weird. And so that's really the challenge, because our valuation is, in my opinion, really hard. So it's hard to raise equity. We won't raise equity at these prices. That won't happen.
But there you go. Let's get creative here, because if you look at people like Queensrand Capital, they kind of love to throw a convert at a company or two. Yeah. What I'm saying is, do royalty companies need to reinvent themselves? Meaning, do you need some more products in the portfolio to be able to deploy capital across different timeframes?
Yeah, we've looked at it potentially. I think the nice thing about royalties is really just that longevity, and that low maintenance, where you don't have to do anything.
Sure, but you can do that from the beach in Hawaii, right? So you're saying that there are moments where
I could go to the beach in Hawaii for the next 5 years. It might be the best thing that ever happened to the company. Yeah. Because our future looks that bright. We probably have 1,000 people working on our projects right now. Yeah. There's hundreds of millions of dollars going into them. Yeah. And all of that costs us nothing. And that's really the beauty of a royalty company. It's long-term stable cash flows. We're already diversified across 21 assets. We're diversified across 9 clean energy metals, all of which have exponential growth looking forward. And so it's really, and we're in good jurisdictions, right? We're in, mostly North America, Europe, and Australia. So from a risk profile perspective, you compare that to a relative single asset development company. And it's really hard for me as someone who's, I'm all in, right? I'm like one of the few CEOs. I'm 95% invested in the company. Myself and my family are very large shareholders. Yeah. We own about 14% of the company. Okay. And so, to put family money in, something that's safe, right? Where it's hard to imagine. We're not hedged on any one asset. We're not betting on any one commodity. We're not betting on, where battery chemistries go, which technologies might come. Yeah. These metals are going to be crucial for a lot of different reasons, whether it's renewable energy, electric vehicles, batteries, electronics, our way of life in the 21st century. Yeah. You're going to need a lot of these metals, and so we feel very comfortable about going out, buying royalties on these deposits, knowing that these are going to come in production at some point in the future. There's just nothing behind them, right, over that timeline. Yeah.
Okay, cash flow positive next year, and I guess you'll start issuing guidance at the points where you feel a bit more comfortable or can do that, because the companies will give you the data to.
Yeah, so a lot of royalty companies do streams because on the basis that they can forecast cash flows, because it's basically like debt. You're basically demanding they pay you a certain amount. Royalties a little bit more tougher to do that from a projection. Yeah. And that can work both ways, where sometimes you're making more money than you thought, sometimes you're making less. Yeah. And that is one of the few things that's kind of tough about royalties.
So how do people like, if I'm a retail guy looking at this thing and going, right, you've got no peers, you're in this space, so far you kind of cornered that bit of the market. Yeah. Well done. But I need to value you. Most royalty companies say, well, value us on our revenue. Yes. There's a good indicator, right? Yeah. You're going to be the same, but what else is there to it?
So there's 2 ways really royalty companies are valued. So one would be off cash flow, and the other would be off net asset value. I think that's much more appropriate for where we're at today. Okay. Most junior royalty companies trading about 1x NAV. Yep. If you look at our portfolio, it's really easy to do a gross revenue calculation, right? What do you expect from our royalty? It's royalty rate. Most of ours are gross revenues, so no deductions. Yep. Times that by the production of the mine that's expected, times the metal price. That's it. That's our annual revenue that we expect. And so it's very simple. It's 3 numbers. Our royalty rate's up there. Yeah. And so from that, you can really understand how much cash flow we expect on a year. You discount those cash flows back on our assets. I can't,
pick a number.
Pick a number. Well, look, I mean, I take Battery Hill as a great example, right? On that royalty alone, it's 47-year mine life. It is the only real source of manganese for the EV space in North America. So there's a little bit more, push for it to come to production. Yeah. We're expecting that's going to pay us anywhere from US $3.5 to $5 million a year. Yeah. So over a 47-year mine life, you're looking at over 200 million US cash flows. Yeah. And here we are, we're sitting at 25 million, company. Yeah. You're expecting one asset of 21 that we have.
But there's a mean, when I start asking about alternative ways of raising capital, right? So you could sell that annuity stream of cash, right?
Yes, we could.
Right now for a lump. I don't know what you'd.
Well, private equity valuations are crazy. Yeah. Right? Okay, they're much higher. Yeah.
Yeah. So if we were looking at, well, we used to do it in the retail real estate business, the North Americans call it, whether we kind of pay maybe anywhere between 12, 14 on that.
Yeah.
Right? And you're like, okay, we'll take that.
Well,
off we go.
Yeah, okay?
But here, I don't know, because there's no peer analysis, there's no way of working out
I thought I tried to help the market understand that when I signed that deal on Seymour Lake. Now, we didn't ultimately go through with that.
Yeah.
Lithium prices were going much higher.
Yeah.
They doubled the resource, since we signed. So we didn't end up closing. But that was a royalty we'd bought a year earlier, basically. We paid $1 million in shares, and we were going to sell part of it for $4 million. Basically 12 months later. I was doing that to partially show what the private equity groups out there are showcasing in valuations. I mean, I wish I could just, do what they do and hey, here's my NPV
hold it up to
I
camera.
want this. Yes, I want this price,
Yeah.
We're a public company. Everyone, we're kind of stigmatized by that fact. Oh, you're public. That's what the valuation is.
Yeah.
But the fact is there's a disconnect, I think, between right now what private equity groups, family offices, groups that want to hold these assets, and where public valuation is, especially because we do have no comps. Yeah. It is tougher for people to understand, but the market is even bigger than people realize.
Right. Okay. Look, it sounds like you are where you want to be. I'm intrigued. If you come back on, I want some ideas around how do you guys play more of the time rather than sitting on the beach in Hawaii waiting for this wave of money to come in, right?
Yeah,
so that's what I'm intrigued by.
So we're working on a few things that I think might be interesting. I think there's going to be some very unique acquisition financing options.
Right.
We do add royalty or options onto a lot of our royalties, which would allow other groups to actually hold physical royalties if we were to pass those on. So there's going to be some unique ways to do stuff as more money comes into the sector, and you're starting to see that.
Brilliant.
Where you've got some like a lot of big families that have money from different industries. It could be coal, oil and gas. Yeah. We had some from different walks of life as well. Yeah. But looking to deploy capital to what's next, right? Those are sectors we're cannibalizing over the next kind of 20 years. Yeah. Clean energy metals, that's definitely one way for them to deploy it. And I've been expecting it for a while. I think we're finally starting to see that show up as we move forward here.
That's exciting.
It is exciting. Yeah, there's a lot of
genuinely.
Yeah, well, there's a lot of opportunity out there. The crazy fact, though, is that we're still, we've only raised $10 million to date. We put together this, amazing portfolio, and we're buying royalties on the best assets right now. Yeah. Helping fund the only tin producer in Europe. Yeah. It's crazy to me that there's no other money out there doing that. Besides us.
So I was about to wrap it up, but I'm now not going to because, I think for you or an organization who's got one product, it's a one-trick pony, right? So we've got one product, right?
Well, it is,
to be able to walk into a company at any point and say, I can possibly resolve your funding issues. Here is some, let's call it structured finance conversations we're willing to have about that. Obviously, that changes your remit, and it changes the conversation that shareholders would, and I'm sure the exchange will have a conversation about it too. But that's super, super exciting when you recognize some of the challenges that the companies are trying to solve, and just through simple structuring, you can resolve those. I know it's a different company, but in moments like this, there are opportunities to be taken advantage of.
I think royalties are a great way for financing and mining.
It's a good start.
Well, if you look at debt financing, it's really tough for mining. Mining timing, right, is a big issue. Yeah. You can't guarantee timing. So debt, I think almost every debt financing ever done in the mining space has been refinanced. At some point, it might have been 6 months in, 12 months in.
Because it's less ideal at that moment in time, right?
Yeah, and then they end up taking over those assets. Those assets are then stuck for a period of development. Equity. It's a very capital-intensive process as well, right? And so equity is very tough when you have to keep going back to the markets and valuations as they are, especially in a market like this where liquidity is low. Royalties are fantastic. It's a win-win for both parties, At the end of the day, we're going to get paid out over the longer term, but it's a much safer way of doing it.
I get it, but if you deal with family offices, they've got a bit more flexibility because it's individual decisions, usually with single-family offices anyway, where they're prepared to have different structures in place, or at least let their capital be used in different ways, which are a little bit more unusual and conventional compared to, well, clearly straight equity, but definitely on the debt side.
Yeah.
So that's what I find intriguing. If the conversations you're having are with family offices, you may find yourself in that territory.
Well, the ultimate goal is for us to be able to dividend our cash flow out back to investors, right? And so, I think most investors would love it if then when they invested in the company, they were actually buying rights to the cash flow of the company.
Right.
And that's exactly what we have. And, very specific rights set out about that. And ultimately, we plan to dividend that cash back to investors at some point. Once we can get, enough size, that'll happen in the next, few years. Yeah. And so, I think it's a much better, way of getting exposure to the space, in my opinion. Yeah. It's much safer, right? You don't have to go in, pick individual commodities, individual management teams, individual assets. Mining's a pretty risky space on the overall, if you have to do that on a single basis. We're 21 assets already. We're going to keep growing. Our G&A is very low. If you build a mine, even a small mine, you might have to hire 75 people full time. It's a lot of overhead. Yeah. You're now committed. Production shuts down for a month, you're in trouble. You're in the admin game, right? Yeah, you take on debt, they might take you over. Yeah. Whereas we really have none of that. If that group does go under and the debtor takes over, our royalties typically going to survive. Yeah. And we're still going to get paid. So even in a worst case scenario, we're still going to be okay.
It's just deferred.
It's deferred, yeah.
Good to see you, man.
It's good to see you, Matt.
Exciting times, man.
Yeah,
exciting times.
It is.
So I appreciate, good to see you here in London, obviously, and stay in touch. I know you will.
I will, yes, for sure.
And I'm glad everything's sort of moving towards positive cash flow next year.
2023 is going to be our year.